Hello everyone, in this video I will give you 5 takeaways from the letter to shareholders from Berkshire Hathaway written by Warren Buffett. My name is Pedro Nunes, I am an eToro popular investor and this is my monthly video where I cover the main events in the market and my portfolio update. The first takeaway is related with the public companies that Berkshire invests. Warren Buffett explains in a simple sentence all his investing philosophy all over the decades he invests, and is to make meaningful investments in business with both long-lasting favorable economic characteristics and trustworthy manager. This is a sentence that summarizes the main components of value investing updated in the perspective of Warren Buffett. Sometimes we see the word moat, but here he speaks about long-lasting favorable economic characteristics. And he also speaks about the managers. The reason is because in this section of the letter, he speaks about the characteristics of the manager of those companies. And I will give you another phrase that is close to this one. We are understanding about business mistakes. Our tolerance for personal misconduct is zero. The second takeaway, it's also very important in terms of the whole Warren Buffett philosophy. He refers to Charlie a lot of times. Charlie and I are not stock pickers, we are business pickers. He speaks a lot about this difference between investing in a business, as we saw in the past takeaway, a business with long-lasting favorable economic characteristics, and choosing a stock in terms of a certain moment of the economic cycle, or just because we think that stock is going to increase over time. The perspective of Warren Buffett, it's a long-term perspective where he focuses his attention on the business of the company and not in the performance of the stock. The market has, according to Warren Buffett, volatility that is not related with the real value of the stock. So the third takeaway is this sentence. It's crucial to understand that stocks often trade at foolish prices, both high and low. He looks at the business, and sometimes the prices don't represent the real quality of the business, and this is also why he mentioned that he doesn't believe in an efficient market. And because of this volatility on the prices of the stocks, he tries to choose the long-lasting business. Of course, he will try to buy it, and he have done it many times in the past at attractive prices, but his main focus is in the business. The fourth takeaway is related with the American economy. He relates the Berkshire Hathaway performance with the explosion of the American economy. And he says, we count on the American tailwind, and though it has been becalmed from time to time, its propelling force it's always returned. He adopts a patient attitude, waiting for the moment that the economic cycle propels the economy higher again. This is very important at the present moment, because at the present moment we are seeing the interest rates higher. This is not favorable to improve the economic conditions, and this is one of the reasons why the stocks are not recovering despite last year drop. What we should do is to believe that in a near future or in a medium term, this will happen again. The right attitude is to wait patiently, investing in the business that have the capability of endure in the future. The fifth takeaway is the world is full of foolish gamblers and they will not do as well as the patient investor. The patient investor is the investor that in times of not so good economic conditions, we may say that we are in one of those moments, that investor, he waits in a patient way, investing in the companies that have the more probability to survive. Lastly, I will cover a little bit of my portfolio. The philosophy of the portfolio, although being my own with my ideas, I value a lot this kind of perspective, and it's wonderful to read the Warren Buffett's letter. Most of the premises are there in terms of having a very stable position to endure this not so good phase of the market, and always trying to have some defensive measures, but to think about the future and about the good companies. In terms of performance, my performance is very similar to the main American index, the S&P 500. At the moment, a little bit less than the S&P 500, but a very small percentage. It was higher during the peak that we had in February. And the reason it was higher, it's because although the portfolio has some protective measures, it also have a vision of betting on the stable companies in the tech sector. Some of the big giants like Google, like Apple, and the tech sector has been highly affected, mainly because of the increase of the interest rates. And when the market recovered, the portfolio has some exposure to that sector, and the performance was better than our main index, the S&P 500. Now we are just 0.2 or 3% below, but as I mentioned before, we are in a very patient position, and we will wait and we'll do our best in order to, when the economic cycle propels the economy and the stocks higher, we will be there. And we also are betting on the American tailwind. Investing is a patience game. Investing is waiting. Investing is being present in the market. This was the March investment dossier. I hope to see you again in the next month.